Good afternoon, everyone. I'm Linda Paulin-Hebden, and I'm so excited to be here with you to moderate the panel on risk management. And in particular, we are going to talk about strategic risk management in an era of declining budgets and increasing regulation. Before we get started, one housekeeping item. If you are looking for continuing education credit, the code word is smaller. That code word again is smaller. So before we dive into the materials, a little bit about myself and our panelists. I'm a lawyer. I've been practicing in the area of investment advisors for over 30 years. So I have gotten to see everything throughout the past 3 decades. And it's been an exciting time and just enjoy working with investment advisors. Jeff, can you give us a little background?
Sure. I'm Jeff Edelstein, and I'm a principal at Granite Investment Partners in Los Angeles. I've been in the business for close to 30 years and have had many different roles, mostly in smaller to mid-sized firms. I've been a CCO, general counsel, portfolio manager, trader, and probably just about everything else that you could do in this business. Granite is 12 years old and has grown from $40 million in 2009 to $4.5 billion today.
Great. Thanks, Jeff. Sarah.
Hi, I'm Sarah Ronnenberg. I'm the Director of Compliance at Horizon Investments based in Charlotte, North Carolina. I've been in the industry over 20 years. I didn't start in compliance. I evolved into compliance. And like Jeff, I've had a number of roles across the spectrum in the industry. And I've worked for startups all the way to large corporations. So I definitely have seen my share of risks across the spectrum. We are a goals-based investment advisor. We offer our strategies via mutual funds, sub-advised ETFs, and also SMAs.
Great, thanks, Sarah. And Naishi?
Hi, so I'm Naishi Tiwari. I'm the former CCO and compliance counsel at Elvis. I've spent my nearly 25-year career helping build effective compliance frameworks, of which risk management is a critical part. So I'm especially pleased to be here today because having served on the planning committee for this year's IAA conference and advocating for the discussion of risk management, I was thrilled, honestly, to learn that the IAA had added this session on risk management for smaller firms. Thank you.
Okay, well, let's get started. So today what we're going to do is talk about risk management. Who's responsible in the firm for risk management, how we can be more strategic about it, how we can evaluate and respond to risks, implement controls, and then we're going to talk about what are the recent trends and what is your liability as a chief compliance officer. And finally, we're going to talk about how to manage all this with shrinking compliance budgets. If you have questions, feel free to put them in the chat function, and we will try and get to as many questions today as possible. So, Naishi, why is risk management important to an investment advisory firm?
For all the reasons that you detail on this slide here, Linda, but, if we take a step back and think about what is important in the risk management function, it really is incumbent on a small firm to think about how effectively do you work and efficiently with very limited resources, right? So if you're finding a way of thinking about risks, meaning the methodology for determining that focus using these scarce business resources, the question is, why wouldn't you have a risk management framework, right? It does a number of things right off the bat. It helps you understand what risks are there at your firm. It helps you triage resources for these areas of risk, understand the controls, the procedures, maybe insurance that you use to mitigate these risks. So, and it also gives risk ownership. So it sort of helps people understand where they fit in into a risk management program. So for all those reasons, plus the details that you have here, which is a lot of the why that I know we'll cover later, it's really important to start sort of getting our arms around that as small firm advisors, whether we're in compliance or in the business, because it really is the core of functionality for a business.
How do you, especially for small firms, there's so many risks to think about. How do you right size your risk management program so it fits the firm?
Mm-hmm. Yeah, it's a great question. And so it's the first thing that I started when I was building the platform for Elvest. So there I was in a newly registered firm, right? The firm had registered in, I think, in November of 2015. I came in January 2016, brand new to the firm. Yay, check, we have a compliance manual that was provided by an outside counsel firm and tailored a little bit for what was going on with the firm, but really nothing much else. So you're saying to yourself, does my compliance manual map into what the firm's actually doing? I didn't know at that point. So what I did to right size was to go to all of the business unit heads and say, look, what are the risks that are in your business? What keeps you up at night? What worries you about the certain things that you're doing? And I coupled that with my understanding of their various business units. So, if you're thinking about portfolio management and it was a digital investment business, you can imagine that the algorithms that run the engines that generate the investment advice would be something that I would naturally bring to the table as part of the discussion with the portfolio managers, right? But after you're thinking about risks, you're doing the similar things that I was talking about before, which was you're establishing ownership. Those business unit heads now know that, hey, for these lists of risks, these are the types of procedures that we can work on together to help mitigate that risk. And they know, should these risks change, there's a person that would either raise the knowledge of something's changed, or they'd be responsible for helping write different procedures, right? So you've got, in that way, a beginning stage of right sizing the the risk management framework. But you also have business owners that have subject matter expertise, right? They're the SMEs. They know how integrally, and speaking of portfolio management, how those algorithms are written, how that portfolio works and operates, right? If you're marketing, what and where are you going to market to? So, really drilling into where and how they're working using their subject matter expertise. And then understanding the key risks affecting the business. If we're going to offer retirement plan services, is ERISA a component, the regulatory side for offering retirement services? Then looking at assessing the controls, right? Are the procedures that are in place when I came in, January 2016, were they working? Were they there? Are they written? Are they repeatable? Do we have adequate personnel? Is there processes there? The controls, are they adequate to mitigate the risk? So say you have a risk and you've got a control, but you know that even with the control, it's not mitigating the risk all the way down to low, right? In a high, medium, low sort of spectrum, you sort of start saying to yourself, okay, well, now I know I got to pay attention to this risk, right? Until we can find a way to mitigate that risk, or we can agree with the business of risk assumption, right? Maybe it's in their risk appetite, something we'll cover later, that, we understand that this is a risk, and, we're willing to assume some of the consequences for not fully mitigating it to a low or a risk level, right? Lastly, I would consider monitoring, right? Testing, establishing key risk indicators for areas that are high risk, things like client complaints, trade errors, operational failures, service issues, payments to clients. Those are things that you can sort of keep your eye on an ongoing basis through governance. Let me stop there and see if that helps.
That's great. Actually, that was an awesome overview. And one of the things we're going to talk about more is who all is responsible. And what I heard you say is that you bring in all your business folks into the compliance discussion and the risk management discussion. So I think that's an excellent point. Jeff, there are a number of parties who are interested in risk management. Can you talk a little bit about the different interests of each of these groups and how you are dealing with risk management with respect to these different parties. Jeff, we can't hear you right now.
Yeah, sorry about that. I think our risk management experience, has really incorporated feedback from all these, parties that you've listed here. I mean, clearly, conversations with regulators, SEC, DOL, and others, help frame the framework that we've used. We have, our business is mostly equities and high net worth individuals, and we have a significant amount of sub-advisory business with large financial institutions. So, their expectations of our risk management process have really helped inform us, I think, of best practices. And we've listened to them and interacted with them and discussed, how to improve over time. Third-party business partners, especially firms that are, have outside investors, or maybe looking to have outside investors in the equity of the firm. Being able to understand their concerns and long-term experience, and obviously, and importantly, your internal board of directors or managers or partners. We converse with them all the time. So it's been a very iterative process with all of those different groups.
Is there, a lot of times when I work with clients, I hear a lot, and the questions I get are, what will the SEC think? So the regulators are top of mind. But when you're developing and implementing your risk management, is that the most important group? How would you prioritize your audience?
I think we think a lot about how our clients and how prospects would think about us. We've had, over a long period of time, you learn how to take feedback and constructively from your clients or from prospects in this, how you've structured your firm and your processes. I think, and clients, ultimately, they're to me equally as important as are your partners. Ultimately, if you're the risk manager in the firm, you're accountable to your partners to keep the firm moving forward in a positive and to prevent it from making unnecessary mistakes.
Great. Sorry, I think I went one slide too quickly here, so apologies for that.
Yeah.
Sarah, the SEC has made it clear when it comes to CCOs, empowerment, seniority, and authority are important. What is the SEC really getting at when they're talking about those things?
It's been a continuing theme for this past year, and even today with the new exam priorities that were just put out, they have yet another portion of the risk of the new risk priorities dedicated to this specific topic. And last week, Atlanta's regional office was also very much top of mind with this. I think the reason why they feel so strongly about this is that the CCO, in order to administer a robust program, needs to be able to see across the firm and understand exactly what all the businesses are doing. And then also being able then to create a program and administer it that is going to have the respect and authority of the people who are part of it. And so how can you expect people to be part of the process and to listen to you if you don't have the seniority and authority that are invested in you? And I think that if you don't have a seat at the table, as they say, or if you're not fully integrated into your company, then how can you really be effective in administering a program that's supposed to cover your entire business operations? So that's why this theme it just continues to percolate throughout all of their remarks and risk alerts, and now their new 2021 priorities.
So a lot of times I hear from firms, oh, that's compliance. But I heard Naishi say earlier in our session that she goes to the business folks and talks to them about, what they're doing. How do you get more people in the firm involved in the risk management program?
Well, I think you have to see yourself as a partner and almost as a consultant, an internal consultant. And so that people don't see you as a no, but rather, how are we going to do this? And once they understand that they are actually part of the process and they are part of the responsibility, I think that helps them understand that it isn't just one person's job, but rather it's a collective responsibility, and that everybody has a piece of ownership in the process. I can't tell my traders how to trade. I can't tell them which brokers to use. That's not my job. My job is to give them the expectations for how to find the best brokers or what the considerations are. But at the end of the day, they know best. It is their role to trade as best as possible. And so I am just part of helping them do their job, but not to take away from their job.
One of the things, go ahead. I'm sorry, I thought one of you was saying something. One of the things too is, do you allow, or do you have a process that others in the firm have some level of approval depending on what the risk is that we're talking about? How have you dealt with that?
I think when we do our risk assessments, we'll do as compliance a general pass. This is what we see from all the inputs that we've gotten, whether it is from the SEC or clients or other parties. But then we do go to the various business areas and ask them, is this what you see? Is this at the level of risk that we're assessing? And if so, or if not, why not? Is it actually a higher risk? Or maybe it's a lower risk? And then why they're telling us it is that way. And because they're really at the front line, they are seeing firsthand what is happening, and they also have more of a business knowledge of how it's actually working. And so that unless I'm doing the job with them, and sometimes it actually helps to sit down on a trading day and see how your trading process is working to get a firsthand experience doing that. But at the end of the day, I'm going to leave it to them to be the final decision makers on what the risk, if the risk is as we see it, because they're the ones who are dealing with it real time.
Great, thank you. Jeff, how do you assess your firm's appetite for risk, and maybe talk a little bit about how different management may have a different appetite for risk?
Yeah, I think it's interesting. I've been in small firms, and I also worked for a large insurance company for 4 years or so. And you really saw the difference in how risk was assessed. In a small firm, where it's entrepreneurial, you may have concentrated ownership and one or a few people. You're really looking at sort of this risk reward of worth my personal reputation. Is it worth, can I make enough money to offset the risk? mean, you're sort of going through this calculus, perpetually in a small business of the risk and rewards of the opportunities and presented to you. In a large, I observed in the large firm, you had very segmented risk and analyzers. So you had, lawyers, you had auditors, you had internal auditors, external auditors, separated compliance. And it was much more of a tendency to sort of go into their own bunker and protect themselves than sort of want to move the business forward. So as in those types of firms, you have to really make a much bigger effort to integrate the business groups with the compliance and other people. Smaller firms, they're tending to work next to each other. And you just, you really, as someone who's responsible for the risk management, you get to be much more involved in, say, the trading desk, as Sarah mentioned, or other activities within the firm, and really learn about it and help yourself gauge those risks. Ultimately, I sort of, go back to the rule I learned in law school, which is you want to avoid the appearance of impropriety and be able to explain what you're doing to the regulators, to clients, prospects, and to your partners. And I think that's sort of my guiding rule in evaluating risk. But each of the other panelists, we've all emphasized it really is a collaborative effort where everyone has to go back and forth. There's a lot of give and take and learning that goes on, I think, to make the best decision.
I'll ask this to really all three of you. What is, if a CCO finds him or herself in a position where their level of risk is different than management, how do you make your way through that process?
I think I'm interpreting your question, Linda, this way, and you can correct me if I'm seeing it differently. So the CCO's level of risk is different from management. I think there's an assumption there that the compliance team owns the risk. And back to something I said earlier, right? Really setting a framework as to where does risk ownership lie. And if some folks here may know 3 lines of defense, that statement, where the business owns the risk, compliance is advisory, like Sarah was speaking about, or, the way Jeff was saying that you're working collaboratively, but the business ultimately is the supervisor. So in the investment advisory way of thinking about this, right, if there's a failure to supervise claim, that it is on whoever is assuming the supervisory duty. So if the supervisor is not compliant, then I think that in that analysis, once you are providing guidance, advisory knowledge about the rules, you're not assuming risk unless you're, I'm a lawyer at the end of the day, you're aiding and abetting, right, the violation that the firm may be engaged in. So I think you can have some clear demarcation. You can present what you believe to be the compliance obligations in a particular situation, and you can contain the advisory component that you would have as CCO without veering into the supervisory component that the Advisors Act lays out.
And I'll also make a little plug for the lawyers here outside counsel, which is sometimes if there is really an issue, and it doesn't happen a lot, but it's also sometimes good to get outside counsel's view on that. So, okay. Nishi, there are a number of items that could trigger a risk assessment. How do you keep your eyes open for trigger events?
So these are thank you, Linda, the things that you listed here on this slide, and I believe in an upcoming slide, you've got sort of regulatory or what I call third party or external triggers, right? That will either impose rule changes, DCC may think differently about a certain way of how you might comply with the rule. But you've also got what I call internal triggers, right? Where if you have, as we've all been stating, a working knowledge of your firm's risk management framework, you kind of know already in that framework where trigger events might come up for the things I talked about earlier. If you know that something is high risk, even despite policies and procedures around it, you've already got your eye on that as a potential trigger. So having a working knowledge of your firm's risk management framework, again, allows you to assess this impact of these new risks, these new triggers, helps you troubleshoot pretty quickly where that issue, which part of the business it's in. So let me give you an example of, cybersecurity. If we are a firm that trades online, as Ellevest is, right, and you've got privacy issues or privacy regulations that are changing under CCPA, the California Consumer Protection Act, right, you've got some knowledge that you should know where your data lies, what data you're collecting from folks, what information is being stored, where it's being stored. So you sort of already know that the trigger for privacy is integrated there a little bit, right? Or you become really quickly aware if the CCPA says, these are some of your obligations under that. So that knowledge that you have from your risk assessment, because of course, compliance with the CCPA would be a risk. The controls would be working with your technology group to understand where data is stored. And then, a risk rating that says if you're not always aware, right? So, for example, Ellevest use social media, and there's a whole bunch of risk analytics that goes on behind social media where data is captured, right? You already know all those places. It's really hard to say. So in that instance of putting a risk assessment together, what you would have is perhaps knowledge of the risk, some good knowledge of controls, but maybe the risk rating would still be high until you could identify all the places where your data may be being kept.
And you alluded to this, Station, but we do have another slide that is just business triggers, because one of the things is it's not just the SEC coming out and saying, oh, watch for these things. There are things that happen in the business that may trigger a new risk assessment. So when does the business team typically bring you into a discussion about a change in the business that may warrant a risk assessment?
It's a great question. And look, I think if you set up a risk framework, you've got good partnership with your business, risk management conversations should be going on all the time, right? At Ellevest, I was meeting with the business, regularly, every 2 weeks, every month in some cases, even after we have established a good framework, because the conversations of where are you seeing this, Nishi? Where am I seeing this? Where's the gray area in between? How do we interpret that? So having that open door policy with your business where, in the days that we had doors, so to speak, right? You have that interaction. So the first time you see your legal and compliance team should not be when something is dramatically changing or not going well, right? So you've got the rapport, and hopefully the conversations are continuing, right? So for new products, say mergers, hopefully you've had those discussions. It's on the radar. You've got a project plan where the business is saying, hey, we're going to go into this new line of business. We're going to start doing the work to risk assess where these new service changes may impact in the various business units. And I think it's a really great time for compliance to shine, to cultivate that understanding, to raise issues that the business can price as it's bringing services to market and incorporate that into the rollout. So really a good place there to, effect on that partnership that you've already started building.
I'd also add that, if you're try to be on committees or in working groups. So just being an attendee, being a member, not necessarily even a voting member, so that you can be aware real time of developments as they start to arise, so that I'm part of our weekly tech team meeting. I sit on the best execution committee. And being part of that natural business process just makes me aware of where our business may be evolving that may not get to me until farther down the road if I had not been part of those meetings.
One of the triggers that I think is a challenging one for privately held firms with closely held ownership is succession planning. Any suggestions on to the CCOs in the audience of who takes the lead on that discussion and how to push along what might be a little more sensitive discussion?
So I say it's a careful discussion.
That's a tough one.
Yeah. So I certainly would say that would be how I would start. But I also think that, as part of a business continuity plan, you've always sort of started skirting the edges a little bit, right? You're sort of saying, if you are not there, our president or CEO, how do we act in this, very time sensitive moment? So we've sort of nudged that conversation a little bit. Although I'd say that I would certainly defer to Jeff to see how that would be best appreciated from the compliance staff as we're moving things along.
Jeff, you're on mute.
It's obviously a challenging discussion, but that's your responsibility as managing a business. Is what happens if for some reason you can't show up tomorrow, and you're managing a portfolio or key client person or CCO. What are you going to do? I think we were all challenged this year with COVID and how you manage your business. So, people who are managing their businesses should be thinking about all these items all the time, every day. Succession planning is time carefully and thoughtfully and think 5 to 10 years later, you'll be well served as that plays out, I think. And it also is, we see it all the time, all these questions, succession planning, certainly at the top of the list, questions that prospects and clients ask all the time. So they want to understand these firms are supposed to be perpetual. They aren't just the life of Jeff Edelstein or my partners. How do you make them live to serve clients for long into the future is a key question.
Sarah, so once you've identified a risk, can you take us through your process of evaluating that risk?
Well, I think sometimes I work backwards and I think, what if the worst happens? And then think through how we would address that failure. And then what do I need to put in place so that doesn't happen? So then I start by looking at what we already have in place. Are there policies and procedures? If there aren't, who needs to be at the table to start to think through crafting them? If we do have them, do they need to be formalized? Maybe it's just a process that people do as a daily task. Do we have functional positions associated with that policy and procedure, so that, going back to succession planning, there's also a key man risk. If that position, that person leaves, do we have backup so that there's an institutional knowledge for that control or that process? And then finally, after looking at everything that we may need to put in place, that we may already have in place, what is the absolute worst consequence of this risk? What is the actual risk to the firm? Is it truly a high risk, given that we have a solid policy, we have solid controls in place? Or is it a higher risk? Is it a low risk because we've mitigated it in such a way? And then finally, are there exceptions? Like, I think you have to think through the whole gamut of creating a policy and a procedure that emanates from that. What exceptions, like if something does come up, what are you going to do to address that exception? And does that exception then become the rule? That's a new risk that you need to think through. And then I know this sounds a little wonky, but sometimes I will go to, if, in particular, if it's a new regulatory risk or something that we've decided to do that's new, I'll go to not only the rule, but I'll go to the proposed release and the adopting release. And I'll see the history of how the SEC was thinking through this particular action. And they do offer helpful hints for how they've seen other firms address this particular issue and what we might want to consider as we stand up our own policy and procedure to address this. So sometimes it's painful. 430-page release is not the best day that I've got looking forward to. But on the other hand, you can find really helpful information in them that you may not otherwise think about when you're working through all these elements.
That's a great suggestion, Sarah. And I would also add, not just reading the releases, but read the footnotes, because for anyone here that's read releases, there's a plethora of footnotes with really good information. So that's a great suggestion. Jeff, how do you, Sarah just talked about mitigating risk. How do you decide if a risk is capable of being mitigated and disclosed, or whether it should just be eliminated?
It's I think it's a multifaceted question. I think again, it's engaging your business partners and all the aspects of the firm. I think it's thinking about what do you have to do to mitigate. What does the disclosure look like? A lot of times, when something's proposed, I'll say, well, yeah, that's great. We can do mixed use soft dollars, but here's what the disclosure is going to look like, and here's how you're going to have to provide to the put in the record in our records, and maybe provide to some of our partners. And do you want to do that? Is that worth the upside of say mixed use soft dollars? I've been thinking about it a lot with ESG, because although I think we are a firm that probably embraces ESG ideology at its heart and has for a long time. Checking boxes on questionnaires that we are, we integrate ESG into our process is a much higher hurdle and result in scrutiny. So how do we create, all the backup that's going to show that we are implementing ESG throughout our investment process is a great challenge. And is it really, do you want to go through all those disclosures, record keeping? Is the upside worth it? In that case, I think it is. And I think, the ESG risks to our companies, if we're not highlighting those issues, is significant. So, we walk through those steps.
And I'll ask this to all three of you. Have you been in a situation where the firm is going forward with something and there's a risk, but you're able to identify a different approach to the business that maybe eliminates or mitigates that risk? What roles can compliance play in that area?
Well, I think that's just the nature of the job. My job I don't see it as saying no. I see it as offering alternatives. And then the business has the choice whether or not to accept my proposal or to not. And as Jeff was laying out, all of the elements that might go into adopting this mitigation, well, if they at the end of the day decide not to accept that is their decision. I can only move the needle so far. I've documented what I feel. I've made my case. And at the end of the day, sometimes it just is a business decision that it comes down to.
Although I will say, like a lot, as much as it's a business decision, when you frame it in a compliance framework, it carries a lot of weight and it has a lot of
Yes.
influence. I've found over my career. So a lot of times, there are things where I've felt that it's been risky, and I sort of say it's not me, it's the
Right.
regulations, or it's
Right.
it's the clients that are asking for this. It's not
Yes.
us, and I think
Right.
we've used that over the years to help drive framework forward in compliance or risk management that ultimately that carries it over the hump, and people
Right.
don't question it as much. So you have to know how to use your role. You don't want to overuse that,
Right.
because but when it's really important, compliance is using that experience that you have as a compliance person, I think is really useful.
I think it's a tension, and I think it does go to what you say. You have to know when to use it, as it's a regulatory, this is compliance saying it. Because I think if you use it too much or too strongly, depending on the situation, your message gets diluted over the time, and so that it can be easier to be ignored. Or people just say that's compliance. We're still, and they've said their piece. I think it can be tricky at times. So, but to Jeff's point, at the end of the day, if the regulatory aspect always should rule.
Great. Thank you. Sarah, tailoring your risk assessment. Tell me, what is the most important part of tailoring your risk assessment to your firm?
I think the expression "don't boil the ocean" comes to mind. You have to really think through what exactly applies to your business, because you can go to all the different examples. We have some great stuff in the supplemental material, and look at 100 different items. But if they don't apply to your firm, then don't start to add them into a risk matrix. You really have to think through what exactly is going on, like who are our clients? We have separately managed accounts. I have to think about the solicitation rule that is going away, but on the other hand, Nashi Elevest that may not have that. So you really have to look at what applies to your firm and then go from there. And you can create the most beautiful risk matrix, but if it doesn't apply to your firm, then it's not going to be any good. And if it's too complicated, nobody's going to use it. So I think sometimes being simple is the better approach. And then as you become more sophisticated and go through iterations of a risk assessment over time, you'll begin to evolve it, and it'll become a better tool through more and more use. But if you're creating something that's just too much, it runs the risk of not being used at all, and then it's no use.
I'll ask all three of you, any suggestions for the risk management, risk assessment tools that you have found most helpful in your firms?
I think, resources is a huge component. And certainly there have been some promising vendors that had the functionality that I had when I was at bigger firms, that had, risk tools that could sort of keep an iterative basis of risk. But the cost was prohibitive, and we certainly couldn't get them through a SOC audit, in terms of vendor review management to make sure that, they wouldn't be in business for as long as we needed them. So we relied on plain old Excel spreadsheets that supported what the business was comfortable with, and it got them into thinking about risks without having to learn a new system in the beginning. I suspect as LMS gets more mature in its iteration, right, those systems will come into play that will be able to, put in more sort of present risk understandings into systems that are hopefully become more affordable at that time.
Great, thanks. Um, Naishi, could you give us an example of an identified risk, how it was mapped, and then the controls that you implemented?
Sure. So let's think about something that most investment managers do, which is trading, right? So ultimately, when you're going to trade, invariably there are trade errors. So if trade errors or failure to effect a trade that serves the best interest of the client, because you are using client resources after all to make that trade, right? You're going to have to sort of think about, what happens when you're not trading appropriately, or, so it's not trading inappropriately. In other words, buying where you're supposed to sell. But, most importantly, failure to trade at all. So if you think about a digital environment, right, there's a bunch of funds that come in, it's queued up, and there's some algorithm that tells it to start sending those trades, to that money, to the broker dealer, the associated broker dealer, or if it's an affiliated broker dealer, to effect the trade. So that period of time, and knowledge about what happens between funds coming in and the trade happening. The analogy on the non-algorithm side is pretty similar, right? You've got your resources there, the asset allocations made on the private wealth side, and now you're saying, I'm going to affect on the asset allocation. Well, if the trading somehow goes wrong, you've breached a restriction, you've bought versus sold, for example, right? Those types of identifications of what causes a trade error to begin with should be identified. So you've got your risks saying failure to meet the best interest of the client. The procedures would say, here's what a trade error means, right? Really laying out there for folks what that might mean, and getting some congruity between your trading staff, your portfolio management staff, your financial advisors, what that may mean. And on the digital side, your engineers, and your operations folks as to what that might look like, because the digital side, has its own sort of parlance, but it's the same principle, right? Failure to do something that you had a duty to do. So advisors, fiduciaries, duty of care, that sort of comes into there. Training to those portfolio managers, and all the other staff that are affiliated. Governance, Sarah mentioned committees, right? So how do we monitor some of this? Earlier, I talked about KRIs, right? Those key risk indicators, having operations trading say how many trade errors was made during a particular quarter, so that you can do these risk triggers and say, oh dear God, have we really had an increase in trade errors? What's going wrong? To be able to sort of say, okay, how can we go back and iterate on that risk? But those are some of the ways that you can map those controls back to that risk of trade error.
Okay. Thank you. Jeff, one of the risks the SEC identified recently was that CCOs wearing multiple hats, which I know does happen in smaller firms. If you wear more than one hat as a CCO, how can you make sure that compliance is still a priority?
Yeah, it seems like the SEC is trying to regulate me out of my career. So, uh, although I'm no longer the CCO because of that. I think you have to have the discipline to put compliance first, or at least put it very high up on your list, and stay very current. Coming to conferences like this, reading the IAA bulletins, newsletter. Um, you know, I think just realizing it's a very imperative role, and also thinking of it as an advantage. that as a multiple hat wearer, you have an insight into all of the other business functions that you're involved in. So use that as a tool, not as not as a negative. I've always seen multiple hat wearers as a positive. I understand the conflicts, but if you're involved in other activities in the business, aren't you a much more well-rounded CCO and risk manager because you understand really what's going on in portfolio management or sales or trading or operations, and you bring those skills back to all these techniques that we've talked about today.
And I'll open this up to all three of you. But one of the other risks that the SEC has recently identified is failing to implement actions required by your written policies and procedures, or failing to update and maintain those policies and procedures. How do you, and maybe it's more discipline that you add to the process, but how do you make sure that you are implementing what's required by your policies and procedures, and you are updating them as the firm grows and changes?
Well, I think it goes to the annual review process, or using something like your Form ADV annual update as an automatic trigger for reviewing a whole host of other things that flow into that, and that can be a starting point for you. Also, maybe enforcement actions that have come out, actually really reading them. Maybe it's not quite your business, but maybe there was something in that enforcement action that spoke to something that your firm did, and see what was brought out in that, and then think through, is that something that's going on at your firm, and do you need to think that through? And that can be another organic way of looking at making it a dynamic process, not just a static one-off when I get around to it.
I think it's all of that, but adding controls as well. The plain old checklist does a really nice job of saying, hey, look, what Sarah was saying, the rules changed. Here are the elements that I need to consider. Now, where are the business units that I'm going to have these conversations with, so you don't lose that knowledge that Sarah's talking about, that, and those conversations you need to have, because gosh, there's a lot of things that goes on in a day, and it's quite easy to lose them, especially at small firms.
Well, let's go on to then COVID-19. So a year ago, we were all going to our offices, and today, many of us are working from home. Nashi, was your firm ready for the pandemic? And what are the things you were glad you had in place, and what are the things that you wish you would have had in place?
So I and the team had worked really, really hard to make sure that the business had done a lot of things in preparation for a business continuity event. Can I say that pandemic planning and foreseeing all of this was part of it? Probably not. I couldn't go that far. So to be honest, I'd say that we had done a lot of BCP testing, tabletop exercises. We had built in flexible work from home policy in the business. So everybody was issued a laptop. We had no desk process. We were already in cloud storage systems that were secure for books and records. People could work from anywhere. So that helped in terms of readiness for the pandemic. But how could we work more efficiently in another pandemic? We've learned a lot of things about distance, how it's really, really hard to be on Zoom all day, how we miss our colleagues, and we wish that we had spent some more quality time getting to know folks, because you lose a lot of those intangibles in the process. So much of culture is compliance, right? The reason I can approach the business folks is because I've built that relationship. And I've offered, myself and my guidance, even at the 11th hour, 12 o'clock at night, here we go, let's get through these things. So I think those are the missing elements that we're going to need to think through back when we get into the office, and how do we continue to build those relationships?
So this is an issue, near and dear to all of our hearts, CCO liability. And, I have heard over and over again from the SEC that they really don't want to go after CCOs, but they do. Um, Sarah, what's your advice to minimize CCO liability?
This is the perpetual doomsday scenario for somebody who's been named CCO. So one of the basic items is being named as an officer in the D&O policy if your position is actually at that level. But I think it helps when you really read through the enforcements. Most of them, it's pretty clear that the CCO was taking a personal interest and there was actions that were not in line with the regulatory expectations. I think in the cases where it's more ambiguous, I always wonder what do we not know. But I think another way of approaching it is that you're always acting in good faith, that you have resources around you, so use them. Create your own personal CCO circle. Utilize the IAA. If something is just not smelling right, talk to somebody about it. Get a not necessarily, I'm saying go to legal counsel, but talk to a colleague, talk to a peer, and get their assessment of it. And then go from there. And then I think if something is wrong, then you have to start to document it and follow it. But I think in the general picture, I don't think that there's this we want to get you aspect to it. I think it's really gone to a level that it had that something else was going on that was not necessarily a CCO. That there was something more.
Thanks, Sarah. And this is our last topic to talk about today. So before we get to that, the code for continuing education is smaller b. That's smaller b. Shrinking compliance budgets. I'm going to open this up as we wrap up today to each of you. The SEC is identified as a risk, a lack of resources. How do you make sure that you have adequate resources that you need? And are you part of the budget process for your firm? Nashi, do you want to start us off on that?
Yeah, so yes, part of the budget process for the firm. And so I think where it makes the most sense is to try and tie resources to your risk assessment. So bringing this back full circle, if we've got a risk and it's being remediated by certain controls, and we need a special counsel for ERISA issues, if we need to understand how we are measuring performance under ESG, if we're going into proxy voting and now we need particular resources for that, vendors or particular skill set, it really does tie the risk right back to the resource allocation. So it's real clear why you're asking for certain things.
Sarah, how about from your perspective?
I think utilizing technology now, when we were talking about risk assessment automation, that technology I think can be extremely expensive and cumbersome for a smaller firm. But just for addressing risks, using compliance technology that's out there, code of ethics. For trading, you have all OMS, and you can generate exception reports. And for compliance, we use those exception reports all the time. Even vendor risk management vendors that are out there, that they can also help you. So thinking outside the box in terms of different technologies that are there that perhaps the business may use, but you can also harness it for compliance purposes. And then you can also prove out that by bringing on this technology, the cost might be less than needing to add an extra person or two to your compliance team, because the technology is taking care of this oversight or this work.
And
Yeah,
Jeff,
and I think technology's had a huge impact on all aspects of this business over the last 30 years, and the amount of, work and paper that, people that's been reduced is amazing, and compliance is definitely a significant beneficiary of that. I also think, especially as you grow, finding partners, outsourced partners that can really help you, whether it's in compliance, technology, other areas that really help you scale your business without you having to invest in the time and energy to do it yourself, is very helpful. So again, you're keeping your headcount down. You may have a more on the expense line elsewhere, but overall, you get a lot of benefit and leverage off of that, and a lot more expertise than firms at our size are maybe able to really gain. And I just that's one of the lessons I've learned, and we really have emphasized outsourcing in our current firm, and it's really helped us grow and scale the firm much more efficiently than we have in the past.
well, unfortunately, we are really up against our time and we don't have any time for questions. If you do have questions, I'm sure IAA can send them along to us and, we'd be happy to answer those. I want to thank all of the panelists today. You've given a lot of great practical advice, and I appreciate your words of wisdom today.